Hey ACU students, welcome to week 5 of Business 222. Okay, this week we're studying, we're going to start, chapter 10 is divided into a couple of halves, this week and next week. This week, this half, we're looking at the topic of classification of long-term assets. We're going to look at how we value those assets, how you determine the value. We're going to talk some about, in Chapter 10, about understanding how to calculate the acquisition cost of property, plants, equipment, and that sort of thing, and how they're accounted for. Then we're going to start diving into, this week, depreciation, and then next week, disposable of assets and how it ties into depreciation and that sort of thing. It's about long-term assets. What are long-term assets? Well, first of all, you have to remember long-term assets are not intended for resale to customers. These are things that you would buy to put in your office, to put in your plant, to put on your property to use. A lot of equipment in manufacturing, it would be considered a long-term asset. A copier, usually you lease those. I'm not sure what you guys do in your offices. The places where I've worked, we usually lease those, so they're not considered a long-term asset. If you did purchase a copier, for example, you might consider it a long-term asset. And for an asset to be classified as property, plant, and equipment, it has to be put into use for its intended purpose, which is to help you make money, to help you build inventory, to help of the product that you want to sell or the service you want to sell. Here's an example, a chart of a percentage of long-term assets that are part of many companies on their balance sheets. For example, if you look at all the assets on their balance sheet, in a computer and peripheral manufacturing company like printers and that sort of thing, you're going to find that almost 80% of the assets are long-term assets compared to, like, say a clothing store or something like that. And if you go into the look into the service industry, it's way down here. It might even be down here in terms of how many assets on the books, percent of assets on the books are actually long-term. A lot of my familiarity is in the industrial machining manufacturing sector. Yep, upwards of 70% of our assets were always considered long-term assets in the form of equipment and that sort of thing. And you can classify assets 3 different ways. That's plant, property, equipment. Excuse me. Natural resources would be things like, if you had gas under the ground or oil, that sort of thing. Maybe you purchased property that had natural resources. You'd want to capture those natural resources as a long-term asset. But also part of many companies are things like copyrights and patents and that sort of thing. They're not physical. They're considered intangible assets. And here is sorry for my clearing my throat. I'm on the backside of a cold. But here's an example of how you might account for and see these assets on the balance sheet as well as on the P&L or the income statement. And so you can see there's different ways you would classify and understand and use the balance sheet to track long-term assets for, like, natural resources versus intangible assets and what they would look like on the P&L. And notice that they're called different things too. So plant, property, and equipment, they get depreciated over time. Natural resources get depleted over time. And intangible assets get amortized over time. So just remember there's different terms for basically the same thing, and that is like this bleeding out of the value of that particular asset over time. And long-term assets have what's called a carrying value or a book value. And it's just what it says. It's the unexpired part of the asset's cost. And you can see the different ways of how it's calculated below there. And how do you, the question is, how do you recognize the cost of those long-term assets? So there's an expenditure. It's a payment. We've talked about this before about what expenditures are, but in this case, a capital expenditure is for the purchase or expansion of a long-term asset. So capital expenditures are recorded in asset accounts. A revenue expenditure is for, like, repairs of long-term assets. A lot of the equipment that I'm familiar with in manufacturing required ongoing repair, and sometimes significant maintenance. And those costs got captured not as part of the long-term asset, but in what's called a revenue expenditure account. So capital expenditures would include, whenever you put money out to buy assets, to buy plant assets, resources, intangible assets, that's considered a capital expenditure. In most of the places I've worked, not only did we do an operating budget, we did a capital expenditures budget. So by near the end of the fiscal year, we would start outlining by month what our capital expenditure plan was, to buy equipment, or to purchase long-term assets, or to update our current long-term assets. So we actually budgeted. We had a capital expenditure budget that we were held to. And so there were examples: additions, betterments, and extraordinary repairs all went on that capital expenditure plan. Let's switch gears for a moment and talk about computing the acquisition cost of an asset. We're going to talk about 3 different methods of depreciation and how some of those get accounted for. Next week, in week 6, we'll talk more about how some of the journal entries will go for when you dispose of assets, and that sort of thing. So the acquisition cost of plant, property, equipment, includes anything it takes to get that asset up and running in your plant or in your office. So it's the cost of the asset is really equal to the purchase price, which is just the beginning, plus all other expenditures that require that for the asset to become to put it in use and to start producing the service or the products that it was intended for. And you can see some footnotes here, some exceptions as well. Expenses that wouldn't be debited to the land account, for example. That should be debited to the land account, sorry. The purchase, so if you're purchasing land, it looks a little bit different. The price of the land, commissions, fees, all the closing costs, and that sort of thing. All the assessments by local people, landscaping, all go into what would be the debited to the land account. Some improvements to real estate, like driveways, parking lots, fences, have a limited life, and they instead get depreciated. Whenever you gravel a driveway with gravel, it might last 3 or 4 years, and you got to do it again. So that's more of a long-term. That would be more of an example where you depreciate some of those improvements, and they're recorded in what's obviously called land improvements. So kind of a different account held altogether. If you were going to trim trees, for example, some of those might be inexpensive. It's a major deal. You might depreciate some of that too. Improvements to leased properties. If you have leased properties, things like additional walls, carpets, that sort of thing would go into a leasehold improvement account. We lease our building where we're at, and so I'm sure the landlord has a leasehold improvement account. Whenever there's equipment that has to be repaired, upgrades that have to be made, and that sort of thing. The cost of equipment includes expenditures connected with purchasing equipment and preparing it for use, just like we talked about, but that includes also even this thing about test runs to ready the equipment for operation. Which is very typical in, at least in automotive manufacturing. These test runs have to be demonstrated first before customers will buy parts. Some of that would be able to be depreciated because it's part of the capital cost. Let's see. Let me move down the list here. Okay. So let's talk about depreciation for a minute. So depreciation is really like this bleeding out of the value of the asset over time. There's physical deterioration, there's obsolescence because of design or technology, and depreciation is recorded even if an asset increases in value. And the reason you want depreciation is you want to try to match the depreciation value for a particular time period to be matched with the revenue it's generating for that time period. And so that's why, if you buy a $100,000 piece of equipment, but you're only producing $50,000 worth of parts with it in year one, why would you take it on the chin, the whole 100,000? Why not chunk it up over, chunk that expense up over years? Yeah, the cash outlay was $100,000, but that's on the balance sheet. In terms of the expense side, you don't have to recognize all that $100,000 at once in the year that you bought it. You can depreciate it. So you're kind of matching your equipment expense with your revenue. So, number of factors that go into depreciation. It's the cost. It's this thing about residual value or trade-in value. If you've leased a car, you understand the idea of residual value. There's this depreciation, depreciable cost, and the whole idea of estimated useful life. I would say if there's any area open for abuse and depreciation, it's probably this area right here. People can overestimate the useful life of something, reduce the expense annually, and it still, anyways. That if you're looking for areas of abuse, that would be it. You can probably hear my grandson in the background. He's getting ready for bed. Okay. So there's 3 different ways of calculating depreciation. I'm just going to hit them real quickly. They're in your book, but one's called straight line method. This is the easiest one. You just simply take the cost of the asset and subtract off what's called the residual value divided by the estimated useful life, and boom, that's your depreciation expense per year. Okay. The other method is called production method, and it really tries to track then, especially in a manufacturing environment, you're only going to depreciate as much of the value as you used it this year. And so the assumption is that the depreciation is solely the result of use and that the passage of time plays no role. So this is more based on depreciation based on use, not based on time. The example they give is in a car, but you could apply this to equipment as well. So, and then let's look at what's called the accelerated method, and it's just a quick way to look at this is it's another way to do depreciation, but you get rid of the value much quicker. You bleed off the value very quickly, and there may be times when you want to do that. As it says, it's results of large amounts of depreciation in the early years of an asset's life rather than in the latest years. When the equipment is new, for example, or that thing is new, maybe it's generating more revenue for you. So later on in years, you don't want to be hit with, that depreciation cost when maybe it's not generating any more revenue for you. If you use the straight line method, you might still be being hit with large depreciation expenses even after the asset has kind of like outlived its life. So that's the accelerated method. And this would be an example of like what's called the declining balance depreciation would be like 40% versus 20%. If you just did a straight line calculation, straight line depreciation, you might get 20% for an asset. You do 40% the first year. This is an interesting chart. So take a look at it in your book and as well. But you can see the 3 different methods: straight line, production, double declining. Double declining gets you, gets you like down to that, almost down to 0 carrying value pretty quickly over the years within the same time period. You see straight line, it doesn't matter how well the asset's performing, each year you're going to take a hit like this. And the production version follows your production curve that you would have on your plant floor, for example. So your only depreciation, how much you actually use it. But they all end up eventually down at near 0 for the carrying value. Okay, listen, that's it. Give me a shout this week if you need to get a hold of me. Make sure you read all the sections of Chapter 10. I think it's like learning objectives 1, 2, and 3. And then next week we'll do the balance of Chapter 10. So, all right, listen, have a great week, guys.